Think you can't get started today investing in property, earning around 90K? We've got 4 property millionaires sharing their 7 steps on how they'd start again today if they were earning 90K. We wanted to do this to show you not 1, but 4 ways that you can get started investing in property in 2024. Our panel's starting with Mat Fisk, 25-year-old entrepreneur who's built a portfolio of 15 rentals. This guy's 25. Next up is Cate Bakos, buyer's agent with decades of experience in the industry who's built a substantial portfolio herself. Then Rob Flux, educator, developer who has built quite literally millions of dollars worth of profit in property. And our 4th and final panelist, Richard Morgan, mortgage broker, family man, and an investor who's built a $20 million portfolio. My name's Todd Sloan. You're listening to the Pizza and Property Podcast. Whether you're new at investing or experienced, you are in for an absolute treat this episode. And if you want more of this content, hit the subscribe button. But right now, let's start chatting with Mat Fisk about his 7 steps. Mat Fisk, it's been a while, man. How are you?
Good. Thanks for having us on again.
Mate, it's an absolute pleasure to have you back on the show. Your episode did tremendously well. And if anyone's listening right now thinking, I want a little bit more of this guy's story, rewind a little bit. We're actually going to have a link to Matt's episode in the show notes because you're going to want to watch this guy's journey. But right now, I want to talk to you about if you were going to start again today, because some people might look at it and go, yeah, okay, this dude's super successful. He's worked hard for it, but he rode a bit of a COVID boom. It's like, well, hold on a second. There's still a lot more to it than just a bit of equity uplift that's come from the market. And this is why I'm really pumped to hear you unpack your 7 steps of how you'd start again today if you were earning 90K. So before we get into the steps, Matt, is there anything you want to kind of set the stage with first, mate?
Not really. Hopefully this episode's a little bit better than last. That was my first episode, so it was a little bit shaky, but no, I appreciate you getting us on. And it's awesome to be rubbing shoulders with other guests that are on as well. They've got pretty sizable portfolios, so stoked to be able to jump on with them. And yeah, sort of can't wait to hear their opinion as well.
Beautiful, man. Well, I reckon there's going to be a contrast between all of you, which is exactly why I've chosen this lineup quite carefully. But why don't we jump into step number 1? What would you be starting with today, mate?
So I guess for me, the first step, so the scenario is you're on 90 grand a year. You've got, I think it was an 80 grand deposit, was
80 grand deposit, yep.
Yep. So you got no HEX debts, no car debts or anything like that.
Yeah, pretty clean record.
Borrowing figures, you said, were roughly sort of in the 5s to 6s or so. Single guy. So the borrowing was pretty good. Income's pretty good. Got a fairly good deposit. So everything sort of checks a box there. He should be able to sort of move. If it was me, should be able to move fairly quickly and fairly easily. So I guess first step is going to chat to a broker. You obviously need to know what you can borrow because that's going to help determine what sort of property you're sort of looking at. Yeah, a lot of people look at the prices of properties in their backyard. So I'm on the Central Coast, for example, and properties are 800, 900, a million. And it stops a lot of people from getting in because they think I can't buy. So if you go chat to a broker, you can really find out exactly what you can buy, what you can sort of borrow. So you want to chat to a good broker as well. So maybe get a referral from a friend or someone else that's bought a few properties or has a bit of a portfolio themselves. Having a good broker is going to be huge. You want to be able to borrow as much as you possibly can.
I want to ask here because this is something that I see all the time. People are like, yeah, but I talked to my broker and they said that I can't do anymore. And then I'll put them in touch with someone and all of a sudden their borrowing power opens up. I know that you mentor a few of the guys at your gyms as well. I'm sure you've had a similar experience. What are the questions you think people really need to be asking a broker to get the most out of it so they're not in that kind of, I thought that was all I could get, but it turns out there's actually better options?
When you're finding a broker, you really want them to be managing other big portfolios themselves. So if you can get a referral from a friend who's got a big portfolio, I guess, yeah, they've obviously built theirs. And then when you're chatting to the broker themselves, if you ask them what's their portfolio like and what, I guess, obstacles they've had to overcome, are they into trust structures and stuff like that? If they've got a portfolio of themselves, that's a big check. So you don't really want a broker that's only got 1 or 2 properties. If they've got a sizable portfolio themselves, they understand the hurdles that you might encounter if you're trying to build a big portfolio yourself.
Someone that's done it can help you do it, sort of thing.
Yeah, big time.
Love it. All right, man. So we've seen the broker. What's step number 2?
So step number two, double down in your savings and tighten up any loose spending like betting or eating out or anything like that. Try and save up as much money as you can and tighten up any sort of loose spending because obviously banks aren't going to like sort of betting, gambling habits and stuff like that. The bigger the deposit you can have and the better your serviceability is, the more you can sort of borrow and sort of quicker you can sort of move forward, I guess.
What are a few of your hacks when you started to actually save money, but not like completely shortchange life? Because like I've seen your Instagram, you're a pretty fun dude, Matt. Like you're flying planes, you're living life, you're doing things. What are a few things that you're like, yeah, this is what I do so I can still save, but I'm not just sitting at home eating toast looking at the TV?
So I guess lucky at the moment to have the portfolio I sort of do, which sort of helps us to, I guess, live the life I sort of want to at the moment. But over the last 5 or 6 years of investing, there's been a lot of sacrifice. A lot of investors will sort of know that. So for me, it was, I guess, living at home with the oldies for as long as possible.
Yeah. Okay.
The longer you can sort of stay there and save on paying rent and moving out, the more you can sort of save. Obviously, you want to work as much as you possibly can. So people might think working 38 hours is a big week, but you really need to be working 50, 60 hours, work 2 jobs, work overtime, do as much as you possibly can to get that income up because that's what's going to, I guess, please the bank, the serviceability side of things. And then it's, if you can sort of make your own lunch and stuff like that, just little things there instead of sort of getting takeaway each day, you're going to save a bit of money there. So there's plenty of things you can do, but I guess they're the main ones that come to mind.
All right, so we're really tightening in on the savings, increasing work hours if you can. So whether you've got a job where you can do that or you can't do that, there's bound to be a side hustle if you've got a little bit more of a fixed income. But whatever you can to increase your income. If living at home still an option, if someone's a little bit younger, awesome. Actually, even if someone's older, I moved in with my mum when I was 30. Was not the funnest part of my life, but I'm so glad I did it because wouldn't have the portfolio I've got now if I didn't do that. What are we doing for number 3, man? We're seeing the broker. We're saving as much as possible. What's step 3?
So number 3, if you've got the money, potentially look at engaging a buyer's agent. So they can be really, really useful, but you want to have enough money in your savings where it makes it worthwhile. If you're scrounging around sort of trying to get the first and second property and only just going to get a deposit together, you might not sort of go with a buyer's agent. But had a few friends, they've got inheritances or big payouts or whatever it is. So they've got a few $100,000 sitting there. So the 10, 15, 20 grand for a buyer's agent can really be worth it because they're going to be able to help you find a property that's going to get awesome capital growth and great cash flow as well.
And what do you reckon for our situation with the 80K? Do you reckon, because you could still use a buyer's agent and go that way and probably leverage yourself a little bit more, would you still go down that route or maybe not?
It really depends how much time you have to, I guess, research the market yourself. If you're working 60, 70, 80 hours, you might not have time and you might have to sort of do that. Otherwise, you could end up with a dud property. It depends how confident you are in, I guess, finding an asset that's going to be a good, solid one. If you're not very confident, I guess, potentially that is just enough money to still get a house and sort of pay get a buyer's agent, but it's a little bit skinny there, that 80 grand. So you may not have enough.
Yeah, it's getting a bit tight, isn't it? So what are we looking at then for step number 4?
By now, you should have your budget from your broker. They're telling you what you can sort of buy. So jump on realestate.com domain and start researching, looking in areas where you can afford to buy and stuff. Start following the market so you know what's popping up and you know what is a good deal. So you can be following a few markets wherever you're sort of buying it, whether it's in your own state or in a state, but just research a market.
So when you're researching a market, what are the things you're specifically look for? Is it just what's listed, what's sold, or are you really going deep into the data?
I don't go too deep into it. I'm more so just looking at what's up at the moment and just tracking that. But you can still punch in what has sold, what's renting, what rents are in the market. I guess you want to understand what your strategy is as well. So are you going for something that's high cash flow? Are you going for something that's more capital growth, commercial, a mix of all of that? But that's where domain and real estate's really good. You can punch in all those things. You can see what's on the market at the moment, what's renting, what's sold in your street or surrounding sort of streets. So yeah, it's getting a good understanding of that in the market you're looking at.
And if you're on 90K, you say strategy there, which strategy would you be leaning towards? More cash flow to try and like complement the wage or?
So the strategy I've used is looking for, I guess, cheaper, more regional properties that do provide a bit of good cash flow. So if you're on 90 grand, it's a great wage. I would still be looking, I would still be following that strategy and looking for sort of, yeah, regional sort of properties that provide higher cash flow. I personally wouldn't really go for a capital growth strategy unless you're a doctor or you're earning sort of 3, 4, 500 grand a year. So yeah, if I'm buying a property, I want it to put money in my pocket.
So you're going to be researching, understanding your sold prices, but you're really going to be picking an area that's got a good median sort of high yield to it, and then potentially adding a bit of value, like from the renovation side of things. Or am I jumping ahead a step now?
Oh, I think I might have that down there, but yeah, I wouldn't reno it too early unless you get stuck and can't go for another property.
Okay.
Yeah, so it's just looking for something that you can just rent out straight away. It's got a good rental yield. The properties I'm looking for, you want a bit of a mix as well. So if you know you can get some good capital growth as well, or potentially add a granny flat or do a little reno or something down the track, that's a bonus as well.
Perfect, man.
You want a good mix of everything.
What are we looking at for step number 5?
Take action, move your butt. Don't get stuck waiting 3 months, 6 months, or whatever it is to get a bigger loan. As they say, analysis paralysis.
Mm-hmm.
Once you've been approved by the broker and you're ready to go, try and get moving as quick as you can, because the sooner you get that first one, the sooner you can go for your second. So don't sit on the sidelines, sort of take action.
All right. When you're chatting with like guys at work, you're helping other people, because you get this question a bit yourself as well. What do you find usually helps shake people into action?
Going to see the broker. A lot of people just hold off. They don't know where to go, who to talk to, what to do.
Mm-hmm.
I guess seeing the broker is the first step. So that's what I get. Sort of anyone that asks us what to do, like that's the first step. Go see a broker. Then you know exactly what you can borrow, and then go from there.
The reason this is step 5 now is you don't want to get that momentum to start building and then all of a sudden have it stall. You're basically saying just like keep it going. You've taken these steps now. They're more than likely the hardest steps that most people don't take. Just keep it going and keep taking action.
That's it. Yep. So 100%. So it's, as they say, time in the market is better than time in the market sometimes. So yeah, sometimes it's just better off just to get something rather than nothing, because you could miss out 3 months, 6 months down the track.
100%. So we've seen the broker. We want to be saving as much as possible, working a bit more if we can, potentially using a buyer's agent. In this scenario, potentially a little bit skinny, but that's could go either way. Researching the market as much as we can. If we're using a BA, we're probably not as much. That's what they're doing. But if we're not, then we're getting to know markets, looking for higher yields as well. And then we're taking action, making sure that we're not just sitting around and going, I'm just going to research this market for another 6 months, 12 months, 18 months. Before you know it, you've missed the boat. We've got another 2 steps left, man. How are you pulling this off?
So I guess a little add-on in there. I didn't put it in my notes, but I was going to say potentially put a few offers in on a few places. So don't get too emotional on one property, because if that's your be-all and end-all, just that one property, you love the bench top, you love how it looks, you love the paint and stuff, you can get attached to it and potentially pay overs for it. So I like to look at a handful of properties and maybe sort of put a few lower offers into all those properties, play the game with the selling agents and see if any one of those bite at a cheaper price, because that at the end of the day, if you get a cheaper one, it's going to help your sort of return.
If you're listening right now, hit that rewind button or scrub back if you're on, what's it called? YouTube. I don't know why I just forgot the word for YouTube, but because what Matt's just said is so important. And the reason I think this is so important, because it costs you nothing, but what it will do is it'll help you overcome any of that fear of, oh, should we be offering that? Oh, I'm not sure. What are they going to say? If there's any kind of a fear of rejection, if you've got no fear of rejection, you're probably good with this. Most people I talk to though, they say, oh, I can't offer that. That's too much. Doing it this way, the way Matt's talking about, doesn't cost you anything, and it's absolutely going to help you get comfortable with the process, realize that the world didn't end and the agent didn't like carry on like a pork chop. It's just a part of how this works. And the best case scenario, especially if you are putting in a low ball offer, you get surprised that it actually gets accepted. So I think that's a brilliant first step, man. Just taking action and putting offers in.
100%. So a little one on that. One of the younger guys I'm helping, he works for us. He recently bought a property. I think it was up for 250 grand.
Mm-hmm.
We ended up getting down to 220,000. So it's that's a massive chunk off the sort of purchase price, and it just helps with his return. So it's cash flow positive from day one from the rental return. So it's yeah, doing a little bit of negotiation can go a long way.
Cash flow positive as well. And I'm going to date this now. What are we recording this on? Wednesday, the 3rd, 2024, like in April. Like that is not a common thing.
Yeah, so there's certainly properties out there. I think he only got this about 3 months ago, I think it was 2 or 3 months ago. So there's certainly still properties out there that you can buy at this price that still have good returns. And this property we're talking about, it's still coastal. So yeah, there's certainly those properties out there. So I guess if you got the borrowing power of, like in this scenario, 500-600 grand, I would be potentially looking at sort of splitting it into 2 purchases.
All right, and wrapping things up, what are we looking at for step number 7 there, Matt?
All right, so last step, I guess, is check back in with your broker. So once you've got your eye on a few properties, you know the numbers, you know what you're going to get for the rent and stuff. Check in, get the broker to run the numbers as if you had that property, and how's that going to affect you for the next purchase? So you don't want it to negatively affect you. Like, you get this property and you can't buy another one. So I guess it goes back to having sort of strong rental return there. But get him to run his numbers again. You know what you can borrow for your second one then.
I love this. And I think that this is something that is a real key to growing a portfolio sooner, instead of that sort of property is definitely a long-term game. We both know that, but it doesn't mean that you can't have quicker wins along the way if it's done correctly. And to me, this is a conversation I feel like I have all the time, and it sounds like you do as well, especially being step 7 for you. It's like, if it can't help you buy the next one, why are you buying it? And being able to actually check that with the broker, especially if you're starting again today, before you buy it, is going to stop you then being all excited, sitting down with the broker and going, yeah, let's go again. They're like, man, you can't go again. You've locked yourself.
Yeah, I think it's so important to be able to think about what's happening for your next purchase or the second purchase, the third purchase. Getting one's easy, but yeah, how's that going to affect your second or third purchase? So yeah, going and chatting to the broker is massive. Having a good relationship with them, it's huge.
Brilliant. Matt, is there anything else you'd like to wrap this up with any kind of final words of wisdom?
I guess if it works for one, why not repeat the same thing and do it 100 times? So yeah, if it works, keep doing it. Do it as quick as you can. The quicker you build something big up, the quicker you can retire and live the life you want.
All right, Mat Fisk, absolute pleasure having you on the show, mate. I usually give people's businesses a bit of a shout out, and normally they're brokers or property managers, but if anyone's wanting to smash a workout on the Central Coast, check out Engine Room Gyms. You've got a couple of them now, don't you, mate?
We do. So we've got one at Tuggerah, one at Morisset. We're opening one at Woolwee. We're doing that now. So it's a bit on the hush, but your listeners get exclusive news on that. And then hopefully go New South Wales wide eventually.
You just said it's a bit on the hush. You know, thousands of people listen to this, right?
Great time to announce it.
Mat Fisk, thank you so much for your time, mate. Really appreciate you jumping on the show.
Thanks for having us. Legend.
I wanted to start with Matt because I thought that he's going to have a different way of doing things to most of the rest of our panel. The fact that this guy is like 25 years old and already built what he's built is incredible. And I thought he would give takeaways that would give a lot more relevance for maybe people starting in their 20s, exactly like he did. Actually, I think he started in his teens. But one of my favorite points, 2 of them actually, take action, but putting in offers, taking the action, you've got to do that. Obviously, this guy's a man of action. And some people like to say, oh, I'm just not like that, or that's not in my personality. To a certain extent, it might be, but realistically, it's not a personality trait. It's a muscle that you can flex, and it's a muscle that you can grow. Start small, make it bigger. And this is where I like the putting in offers. It's one of the first things you can do to take action. Putting in a lower offer not only is going to make you feel more comfortable by putting in something that maybe you think is really cheeky and learning, actually, hey, this actually isn't that bad, but it's also going to start that momentum on slowly taking action that will potentially lead you to bigger action steps that, again, are going to help you grow a portfolio starting in 2024. But maybe you've been listening to that thinking, look, this is all good, but I don't want to buy regionally the way that Matt's built his portfolio. Don't worry, we've got you. Next up, we're going to be speaking with Cate Bakos from Cate Bakos Property, almost exclusively buys in Victoria, and has been in the industry for decades as a go-to figurehead that the media often turns to for market opinions. So let's chat with Cate right now and find out her 7 steps of how she'd start today on 90K. Cate Bakos, it's time to talk some investing steps. How you going?
I'm good. It's nice to be back.
Yeah, it's always a pleasure to have you on the show. Now, starting with 90K or like a wage of 90K, it's a little bit tricky.
Yeah.
And especially in areas like Melbourne as well, it's not exactly the cheapest place in the world to live or invest.
Yeah.
So I think there's going to be a lot of people slightly leaning forward a little bit to hear your take on this. So is there anything you wanted to set the stage with before we get into your 7 steps?
Look, I think that with interest rates where they are, $90,000 is a very good salary. And, it pains me to think that we're having to go through the 7 steps to get something that is a decent investment, but there are decent investments out there. And I've got a few really good ideas to share.
Awesome. All right. Why don't we kick it off with step number 1?
Okay, the first question that is the obvious one to ask is, are we buying an investment property or is it owner occupied? And there are some really good reasons for either, but you've just got to work out what your ultimate game plan is. Obviously, if it's owner occupied at this sort of price point, because as you've said, we've got a $400,000 loan that we can service and we've got an $80,000 deposit. So, at that level, you're under the threshold for stamp duty. So you're not having to look at any significant nasty government levies, and you could take advantage of that. But ultimately, if where you want to be living doesn't suit the budget that you've got, you might be forced to think about rent vesting. So stay where you are now, keep renting or living with parents where you'd like to be, and put your investment money into an investment property and be a landlord.
All right. So step 1 for you isn't so much you should rent vest or you shouldn't rent vest. It's about asking yourself the question, which one is actually going to be better for you, for your situation.
That's right. That's right. Because if where you want to live with $480,000 is giving you no joy, or you're looking at compromised assets, then you shouldn't be doing it.
Okay. All right. So let's say someone's gone, you know what, I don't mind the idea. Actually, which path do you want to go down? Do you want to say they've gone down the rent vesting path, or do you want to go owner occ?
You know what, let's talk about owner occ, because
Okay.
there are some incentives there. You've obviously got the stamp duty concession, but there are a few other goodies that we can take advantage of.
All right. What's step number 2 then?
Okay, so what is the longer term strategy for a home? Where do you need to be? You've got to think about where your community is, what your commute times are like, how much space you need, and then have a look in those particular areas at what your $480,000 buys you. But then we get to step number 3.
Okay. So how does that take us to step number 3? So basically we've assessed the markets. We're looking at our prices. What's the segue to that?
We're doing this for capital growth. Now, that's the challenge that you've set here.
Mm-hmm.
And the whole premise is to start your investing journey. Now, if you buy something as your very first property that's not delivering very strong capital growth, it's a harder slog going forward with your plan, because you've got to generate the deposit for the next property. If you can lean on equity growth to do that for you, you'll springboard into the next one. So the aim of the game, I always say this to young people starting out, if you're investing, try and make your first property your capital growth earner. So if that's the case, depending on which city you're in, if you're in my home city in Melbourne, I'm not going to get excited about recommending an apartment for capital growth. Apartments are great for rental yield, they're great for amenity, but if you're purely looking at capital growth, I think you need to look at a house.
For anyone that's a little bit newer at investing, can you just open up, like you and I are very au fait that with the answer to why that's the case, but for anyone that's going, well, hold on, but apartments in the city, better location, what's she talking about?
Yes. Well, depending on where they are in the city and what the building is like, if it's a high rise, you've probably got pretty strong outgoings. So your strata fees are higher and it erodes the gains that you can have. But also we're talking about the land content, the land value. Mm-hmm. So land to asset ratio is a really important ratio. And when you're looking at the value of the land component versus the value of the dwelling component, you can sometimes get very high land to asset ratio apartments, but you tend to find that houses outperform. And especially in Melbourne, we've got some capital cities that are more forgiving with apartments and apartment growth, but Melbourne hasn't been particularly forgiving over the last 15 years.
Okay. So you're looking for capital growth, even if it's a PPR, because if it's your first play, that's the thing that's going to be able to springboard you to unlock some equity and potentially get you into rental property number 2. Have I understood you right?
That's right. You have. Now, the advantage with an owner-occupier property is if you do have fantastic capital growth, but it's ultimately not where you want to be, you've got that option to sell the property and avoid triggering capital gains tax as well if you've lived in it for a long enough period of time. So there's a bit of an advantage there. Not that I endorse flipping properties, because trading in and out of property is expensive, but if you can find a property that will give you that really strong capital growth at the start and it's not ultimately where you want to be living, you can then do something with the profits. You might be able to split it and go into a couple of investment properties going forward and consider rent vesting even.
And is that then a part of step number 4, like basically being able to get out, or have I misunderstood you there?
No, step number 4, if you've decided that you're comfortable with my theory that you should be looking for a house on its own full block of land, you'll struggle with 480,000 in the inner and middle ring in any capital city, but particularly in Melbourne, you won't get what you're wanting. In fact, you won't get a house for 480,000 in Melbourne.
I'm even trying to think of some of the lower socioeconomic areas in Adelaide. You'd even be struggling right now.
Yeah, 480 is just not quite enough. So then you've got to consider the regions. I could take a client into Ballarat with $480,000 and get them a respectable house in a good area, and they'd get a decent tenant and rental. So there are options there, but you've got to be willing to live in Ballarat if this is an owner-occupier strategy, or another region like that. We could be talking about parts of Geelong. We could go into Bendigo. It's a long way from town and it's not an easy commute. So the question is, will regional life work for you if this is an owner-occupier strategy that's based on finding a house on its own block of land?
Okay, so let's say the question's, is regional life going to work for you as a PPR? If the answer is yes, well, it sounds like you're off to the races there. If the answer is no, what do they do option-wise?
Okay, then we have to come back to the city. And then you've still got a couple of decisions to make. So can you buy a house in Melbourne for $600,000? The answer is yes, but only just. And you will be going into some areas that are only at the very beginning of their gentrification journey, or they're considered more rugged or stigmatised. But the point is, you could get a house for $600,000. In fact, I helped a client buy a property for $590,000 late last year in Melbourne's Laylaw. So the house is only 17 kilometres from the CBD. It's supported by rail. You know, there's a lot of reasons why that was a really great purchase. So it can be done, but you've got to be prepared to look at areas that aren't necessarily super popular.
Out of interest, Kate, 590, is that falling apart? Or was that like a major structural? No?
No. Good house.
There you go. Okay. All right. So if you're willing to go, so you're not willing to go out to the regions, you're wanting to do it again, if we're following the PPR route. If you're going back into Metro Melbourne, but you're going to be going on more of, I was going to say the outskirts, but 17K's out. That doesn't feel like the outskirts. It really is.
Bad, was it?
It's not at all. It
was a noteworthy purchase. They're not all that kind of price tag, but it was a combination of factors and good timing. And she actually pounced when sentiment wasn't all that strong. So sometimes going counter to the crowd can help you.
I liked the descriptive you used. I think it's called a superlative, if I'm about to get fancy with my words, that it was a rugged suburb. I'm going to remember that.
Yeah.
So if you're okay with living in a more rugged suburb, then this is where you can get closer to the city for the same kind of price. But we're still talking like 150, 200 grand realistically above where our fictitious character here that's only 90 grand. Where's the difference coming from?
Yes. So point 6, step number 6, you might have to explore shared equity schemes. And they exist for good reason. They exist to help people get over a pricing hurdle and get the product that they need. So for eligible first home buyers, a shared equity scheme with the state government or the federal government could be an opportunity to consider. Clearly, you have to split your profits with the government, but there are also buyback initiatives that steps in the process that you need to be aware of if you're wanting to purchase back the entire share.
And the shared equity side of things, forgive me if I've got this wrong, because I'm still getting up to date with this. You don't pay the mortgage on the part that the government owns, do you?
No.
So you've essentially got like a tax-free, interest-free, payment-free loan of
portion.
Yeah. Of
However,
like 20%.
they share the profit though. So when it comes time to sell, if they're holding 25% of it, then you've got to share your gain.
So if you pay it back, oh, gotcha. Okay. But I mean,
Yes.
if it's the difference between getting in and not getting in, sounds like a pretty good JV to make.
Absolutely. Yeah, I think if you're looking at having an apartment or a little unit in the equivalent suburb versus a house, then I think it's a no-brainer, Todd. I think the capital growth differential will make it up.
Okay. I'm really seeing where this is going now as well, as far as the investor side of things. Because at first I was thinking, okay, we're going down a PPR route, but I can see how this is now turning into, if you're partnering up, you're essentially accelerating what you'd actually be able to borrow now by being able to partner up with the government, put yourself into an area that's got a stronger chance of gentrification, of capital growth, an asset type that also has a stronger chance of capital growth as well. It's making a lot more sense to then in the future be able to pull out some strong equity and go, okay, now let's build the portfolio versus rewinding to a decision of going, oh, I wish we didn't buy that unit that's maybe sitting there a little bit more stagnant price wise. So that leverage is a huge component to this. But what's step 7? What are we rounding this out with, Cate?
Okay. If someone can't bear living in the suburbs that we've discussed and they really desperately want to be closer to town, then they won't need the shared equity model. They'll be able to get a 2-bedroom apartment. They'll be able to get quite close to town, actually. In fact, as close as 5 kilometres out of town is Footscray. And it's in the west and it is stigmatised, but it's got a lot going for it as well. And it's well and truly commenced as gentrification. And like a lot of suburbs that are exciting, there are bits of Footscray I wouldn't get excited about buying in, but there are definitely bits that I would. So you could do a lot in terms of getting a well-located 2-bedroom boutique apartment in an older style block. When I say boutique, less than 20 in the block, low outgoings, make sure your building and pest inspection stacks up because you don't want to be dealing with any big nasties. But when you move into your apartment, particularly if you can nail one that hasn't been completely renovated and you're paying a premium for it, you could do some cosmetic renovations yourself and take your time. So you're earning money, you're putting it aside to cover your renovation costs. You might pop in a new kitchen or a new bathroom over time. What you've got to be really careful of is not cutting corners and not doing big things without permits or getting trade certificates, because that is an absolute deal killer. If you then go to sell a property one day and all the buyers are asking for your permits and you've done it on the sly and you've had a mate who's a tradie do it for you without permits. So that's another way that you could tackle this. I don't think it will be as smooth sailing as the house on its own block of land model, but it will also give you that nice balance of being close to town and having the lifestyle that you want, and you can add some inherent value yourself.
Yeah, and please listen to Cate on that one as well. I've got a mate that is he has the mindset of, if you can quit school at 15 and become a Sparky, it can't be that hard. He's now electrocuted himself twice. So like, just don't do stuff that'll kill you. Like, But yeah, I love it. So you're looking at something that's still potentially got a bit of a value add to it. Do it correctly, do it above board, but you can also squeeze a little bit more potential equity out that way.
That's right. You don't have to do it all at once. You don't need to have that money sitting there to go straight into the renovation. Move in, deal with a daggy apartment, and over a couple of years, apply your upgrades and you'll reward yourself.
Cate, I love it, especially coming from Melbourne. Whilst it's not the most expensive place in Australia, it's certainly up there. And I feel like this is really going to shine the light on a pathway for a few people that maybe thought that there wasn't a way forward. And going it through the PPR route is, I think, going to be a little bit different to everyone else on the panel. So I've really enjoyed this approach. But is there any kind of final words of wisdom or anything you'd like to add in here, Cate?
Yeah, thanks for having me on this segment. I've really enjoyed it. One thing I will say to your viewers and listeners is Rome wasn't built in a day. And, property is not a get-rich-quick scheme. It's a get-rich-slow scheme. So make a good decision when you're going down the owner-occupier route with investment in mind. Pick something that will be future-proofed enough for you to stay in it and stay happy for as long as your strategy needs you to.
Beautiful. Cate Bakos from Cate Bakos Property, thank you so much for jumping on the show.
My pleasure.
One of the things that really stood out to me with Cate, and the reason that I actually wanted to have her on the show, was because I was genuinely scratching my head a little bit how you'd get started investing if you're earning 90K and you're actually wanting to keep it Melbourne focused. Because let's face it, that's where Cate's expertise are the most solid. She's very, very Melbourne focused. It's like I said, it's not the most expensive place you can live in Australia, but it's certainly not the cheapest. I was interested that she took the PPR route, because we could have gone the other way and maybe it could have gone down a rent vesting kind of route. But being able to actually buy something, it's a PPR. And again, I like her set of steps is more of this process of elimination, making sure that you've got to focus on long-term capital growth, asking yourself, well, look, could I actually live a little bit more regionally if I'm Victorian? If I can't, right, well, then I'm probably going to need to get some help from the government. If I really don't want to get help from the government and go down like a shared equity scheme, that's okay, but I'm probably not going to be able to get in a house. I'm probably going to have to end up getting in a unit that's maybe around Footscray area, to use her example. Either way, her focus the whole time kept on capital growth. And that's very, very specifically because then if you do end up selling later and it's a PPR, it's tax-free, which depending on how long you're going to hold that through a cycle, if you're holding that through a full double and all of a sudden your 450's turned into 900, another 450,000 tax-free will absolutely get you going. But you're also wanting to make sure that you can close that gap as much as possible time-wise in between your purchases, because buying one house every 10 years is not going to give you the same kind of return as buying one house every year, 2 years, or one property every year or 2 years. And whilst Cate's strategy might be absolutely perfect for people that want to do more of a PPR route, maybe a little bit of a light cosmetic like we were saying at the end, it's not going to be as active as our next guest, Mr. Rob Flux from the Property Developer Network. I can always guarantee you, Rob's going to be talking about some pretty hands-on strategies that are going to have a higher level of risk that need to be managed, but a massively higher return if it's done correctly. So let's start chatting with Rob Flux and find out his 7 steps on how he'd start today on 90K. Rob Flux, how you going, mate?
Not too bad, Todd. How are you?
Mate, very good. I'm very glad to have you on this panel because I'm looking forward to your response. I think most people that we've got on, they're going to have probably more of an investor response. You being a property developer and one of the biggest educators in the space, obviously an investor as well, but I'm thinking you're not going to be talking along the lines that anyone else is talking. Hence why I'm, pretty pumped to hear what you're going to say, mate. But is there anything you want to set the stage with first before we get into your steps?
Yeah, and you've kind of hit the nail on the head. The difference between an investor and a developer very much changes the perspective that your lender is going to start to look at you. So most lenders are looking at, can you afford to pay off this property over a 20 or 30-year period? So they're caring a lot about the size of your deposit. They're caring a lot about your serviceability in order to fund the debt and that sort of thing. But property development is much shorter timelines. So we're talking sometimes as little as a month. And typically it's somewhere between 12 months and 2 years in duration. And we're looking to force value onto the property. And because we're looking to force value on the property, we can spin that on its head. And we're no longer looking at serviceability per se, but rather we're looking at profitability of the deal. And that's how we convince our lenders to come on board.
And just in case if this is the first time that you've ever seen Rob on the show, I'll leave a few links to some of his previous episodes because unlocking yourself on the first deal, mate, was the thing that made me, you really stand out to me. I think you made $1 million on the first deal. So if you want a little bit more background on Rob, we'll have a few in the show notes. But mate, if you're happy to start, let's look at step number 1. If you were to start today and you're only earning 90K, what are you doing?
Well, first of all, let's start with the premise of we're wanting to add value to a property. What a property developer does is we actually add value to the property rather than waiting for the market to do it. So one of the things we want to do is choose a development strategy. Now, many development strategies out there, and every single one of them will make money, but only if you get very good at it. So choosing your development strategy that you want to lock in is the most important part to the process. And in my humble opinion, what you really want to do is choose one where you can start small, learn the skills, and then start to scale over time. So do a slightly bigger version the next time round and a slightly bigger version the next time round. So when you look at all the development strategies out there, fundamentally learning how to do subdivisions or learning how to do townhouses / apartments, those two, you can start small and scale. So it's trying to choose one of those two and I guess lock in your first deal on that smaller scale.
Okay, so is that a bit future-proofing what you're learning? Because if you can build 2 or 3 townhouses, you can build 20 or 30 townhouses.
Well, the skills that you're going to learn are fundamentally very similar at that small scale. Now, obviously, there's some nuances that happen as you flex, but what we're trying to do is we're trying to, I guess, keep the core skills that we've learned in deal number 1 and just slightly add to them rather than going back to ground zero and relearning from scratch. So as an example, and you said I guess, the townhouse type strategy. But the first thing that you're going to be looking at is I've got to look at car parking and, where does my bin collection go and turning circles and what's the flow of the building going to be looking like and things like that. So once you've learned those the first time round, doing that to a duplex and doing that to a 3-pack of townhouses, not much difference. When you do a 3, you can step up to maybe a 6, and then the 6 you go on to a 10. So yes, there's incremental steps that are going to happen along the way, but we're building on that core basis and then just adding one extra skill set as we scale our projects.
Perfect. All right. So we're starting with picking a strategy, and preferably, if I can speak properly, a strategy that has a real ability to scale. What's step number 2?
Step number 2.
It's infectious,
to
Rob.
actually learn the skills. Yeah, I know. Step number 2 is actually in learning the skills in actually how to do that. Now, many ways to do this. And, I'll stick my hand up and you touched on it before. I am an educator in this space, but getting education, learning to do what you want to do is super important. This is a risky game. Warren Buffett famously says risk only comes from not knowing what you're doing. So whether it's do a course, whether it's get yourself a mentor, whether it's find someone else who's done that kind of deal and you shadow them, that sort of thing, whether it's even that small 90K that you've got, whether you invest in exactly that kind of deal so that you actually get to shadow that person. Either way, you've got to learn the skills in order to step into that space.
Okay. All right. So we're learning the skills, whether that's through mentorship, but getting involved in a project, maybe in a smaller version of a JV, or whether it's doing some kind of an education course. What's step number 3? Step
number 3, you've got to do a financial self-assessment. In order to do any deal, you're going to need 3 lots of cash. So you're going to need a deposit to purchase, you're going to need serviceability to fund the debt, and you're going to need liquid cash to run the deal. Now, in this particular hypothetical scenario, when we do that self-assessment, we've only got one of those 3 equations. So what we've got to do is understand the limitation that we've actually got and then start to work out, how do I actually start to plug that gap? Okay, so the first part is just do that self-assessment, understand what it is actually going to take for us to actually get there. And then once you know the gap, then the next thing we're going to have to start to do is, well, what are the different ways we can plug the gap?
Out of interest, is that going to change much for someone that's on 90K to maybe like a household or a single person that's on a few $100,000? Or is it's the same thing, it's just the numbers change slightly?
Everyone's circumstances are different, but effectively you're looking at I guess the same concepts between them, but it's the size of the deal they're actually going to go in. And of those 3 things, they're all super important. But the one that is, I guess, the if I'm going to say the deal killer, is the liquid cash to run the deal. So being able to pay for your consultants and your application fees to counsel, and actually the actual bit that funds the cash flow of adding the value, that's probably the most important part. And in this instance, we've said we've got 90K. So we've got to pick ourselves a deal where that 90K is going to be sufficient to fund the cash flow. Or alternatively, we're going to need someone to top up that 90K that might potentially be an investor.
So first of all, we're looking at choosing a strategy, preferably one that scales. We're learning the skills to implement it. Then we're looking at basically doing a financial assessment on ourselves. So we're starting to walk down the path now. We're almost halfway. What are we looking at for step number 4, Rob?
Well, step number 4 is you want to, I guess, find yourself a community of people doing the same things that you're wanting to do. So a support community. Okay, so lots of different support communities out there. We happen to have one called Property Developer Network, but I guess where we run those in 4 different states, Brisbane, Sydney, Melbourne, and Adelaide, but there are other communities out there as well. But effectively, we want to find lots of people doing the kinds of things that we're actually doing, where we can actually learn from the skills of what they've done right, and also learn from the lessons of what they may not have done right. Now, at our particular events, we have these things called real deals, and that is where we share the good, the bad, and the ugly of a project. And so you can go back and look at all of the recordings of all the events we've ever done where that kind of strategy has actually been executed, and learn all the lessons from all the things that have happened to everybody else along the way, so that you A, don't make mistakes that other people did, and B, I guess, go and implement the things that went absolutely right for people along the way. So we're trying to minimize, I guess, the learning side of things, but more importantly, that community that sits around you when you inevitably have an issue or a challenge or that sort of thing. It's going to be someone to lean on where you can actually ask some advice, where they've actually gone through those challenges before. And we do that in a masterminding type process at our events. But also, it's a great place to potentially find some investors to plug the gaps of that shortfall that we're actually talking about as well.
One of the things that I actually really like about this is it's a saying that I say constantly is normalize, don't idolize. And I think that when you're hanging around so many other more like-minded people, because when you get into the property space, especially when you're at zero and you're trying to build something, it can be a little bit intimidating because especially if you're on 90K a year, but when you start hanging around more people and you're like, wait a second, these are normal people doing this as well. All of a sudden it stops being this huge thing and starts being this thing that's like, well, maybe I can actually do this. So I think the sense of community makes so much sense, even just on that potential mental barrier to actually overcome that a lot of people might have.
Yeah, absolutely. But birds of a feather flock together. You want to be hanging around people, I guess, doing the things that you want to do. Just that osmosis. As humans, we're a herd pack. And if we hang around with people who are doing the thing that we want to do, then they're going to support us in actually doing that. If we hang around with people who are not doing the thing that we want to do, then they're going to want to protect us and keep them, I guess, doing the not part of the process. So it's important to find your tribe and hang around with people that are going the same direction as you.
100%. What's step number 5 on the list there, Rob?
The next thing you want to do, mate, is you want to find an area where this development strategy starts to work. So not just what is the strategy, but also what is the deal size. So we want to find area where there's lots of opportunity. So things that match the land size, the zoning, the frontage, those sorts of things, where there's heaps of those opportunities there. Where there's lots of evidence that other people have done exactly what you're trying to do before. That way we can start to reverse engineer their deal to see whether or not they were profitable. We want to prove the profitability of those deals. And what we'll find is there's a development life cycle where we can actually see where there's a period of time where those deals make sense and there's a period of time where they don't make sense. And we want to be in that perfect pocket where the deal actually makes sense. And then if it does, we want to make sure that there's still enough demand that we can go and execute the same thing. And if we find that sweet spot, then that's a deal that I guess an area where we've got a green light. We know there's heaps of opportunity. If we can buy on market, run an average deal and sell on average, we know that on average, we're going to make money. So that's the area that we want to start to farm in.
I'd imagine having that good sense of community around you with like-minded people as well is going to really help as far as helping to actually find areas too, and potentially not even just finding the good ones, but steering away from the bad ones and maybe saving yourself a lot of time researching down a rabbit hole that leads to nothing.
Yeah, absolutely. And so what we've done so far, we've determined what we want to do. We've now determined where we want to do it. What we haven't yet determined is how. And so the last part is the how. So we've got to understand that there are 7 different ways that we can do I guess what I call low or no money down deals, where we can control a property rather than owning it. Because of our limited financial constraints here, we have to think differently. And if we can think differently by knowing that we're going to be adding value to the property, it's about what are the things that we can do that are either going to defer the costs or sometimes even avoid the costs of a process. Now, these 7 strategies that actually sit out there, they're not going to solve all 3 of those problems that I said before. Remember, there's deposit, there's serviceability, and there's also liquidity of cash to run the deal. So not all 7 solve all 3. So you've got to understand what your shortfall is, and then knowing what your shortfall is, which of the 7 are the most likely candidates that are going to fit your particular scenario. First one, deal finding. If you can find a deal that's developable and profitable, then you can flick that on for a finder's fee and you can actually cash in and actually make some money from that, because there's heaps of developers who are more cashed up than you that would lovingly take that deal off your hands because you've saved them a whole bunch of time and effort in actually finding the deal. Second one, project management, the ability to actually run the deal on behalf of somebody else. So you might find someone who is cashed up and already owns the property. They may not necessarily have the skills in order to do it. You may be able to run the project on their behalf and actually be paid in order to do that. Or you might find a developer who's doing many projects and he needs someone to actually do some, gopher work on a smaller project of his that might be able to, or his or hers, I should say. It shouldn't, I guess, call it out that way. So that's the project management side of things. The next one is vendor finance. So understanding that the vendor themselves have a whole bunch of equity that's actually sitting in the property. They may not need all of the cash up front. So they might be happy with a small amount of cash, for example, and they may be able to bankroll some of the project on your behalf. That doesn't happen in all instances, but it does happen from time to time.
Yep.
The next one is delayed settlement with early access. So you might be able to control the property for a period of time and add the value before you actually have to settle. And in many instances, you may have actually completed the project and be able to finish and sell the finished product before you actually own the original product.
Love it.
In which case, the incoming purchaser is actually funding the original purchase. You could do joint ventures with money partners. So they will come in and they'll plug in those three gaps that we're talking about: deposit, serviceability, and liquid cash. You could do private loans. So you might have a high net worth individual that might be able to bankroll portions of your shortfall. And the last thing you could do is a thing called options contracts, where you have the right but not the obligation to purchase a property. And in doing so, you can control the property for a period of time, add the development uplift, and then be able to either on-sell that to someone else with the uplift in place, or alternatively tap into the soft equity you've created through that development approval process and use that to fund the next phase with a commercial loan. So they're the the 7 low or no money down strategies.
I was going to say, we've got one step left, but I know I've been saying this a bit lately, but pull that scrub bar back about 60 seconds if you're on YouTube. If you're on Spotify or iTunes, hit rewind 30 seconds a couple of times, because as much as the rest of these 7 steps are extremely useful, that step in itself, for anyone that's on 90K that wants to get into developing, and it's obviously a very high level kind of talk about it, but those are 7 different ways that you can get into developing with either no or very low money. And I think that, to me, that this is exactly the gold that we're trying to uncover for you guys. So listen to what Rob said again, if you're really wanting to walk down the development path and you're on a bit of a lower wage. But Rob, I got to make sure, mate, that we keep this in the time frame. And I'm pretty sure I've already gone over, but what's our 7th and final step today?
Absolutely. And I'll close out with one passing comment on the last one.
Yeah.
Money's needed for the development process, but it doesn't need to be yours. And that's the most important part. That's how the 7 low and no money down steps work. But the last one, understand the needs of the vendor and then try to position your solution to meet their needs. Most of us get it the other way around. We look at those 7 steps and we go, I need this to be a joint venture, or I need this to be, a vendor finance type deal. And we've got a toolbox full of tools and we only pull out a hammer. So everything starts looking like a nail. We start blowing up deals all the time. Okay. If instead we listen to the needs of the vendor, remember, we've already found an area that's developable. We've already found an area that's profitable. Mm-hmm. If we understand the needs of the vendor, the very worst that's going to happen is we're going to unlock an opportunity to flick it onto someone else for a deal finding fee, because we've already unlocked the parameters of the deal. So that's the very worst that'll happen. But ideally, when we position our solution back to the vendor, it's actually going to look like their idea rather than our idea. So they're going to be much more receptive to the process. And so it's really understanding why they're selling, their timelines for selling, their urgency, their need for certainty. Some people must have cash today, and no matter what, and other people are willing to wait some time, and they're wanting to get higher profits, and they're willing to share risk. So there's a couple of different levers we can pull, but only when we understand what levers are available do we know how to position what we want.
Rob Flux from Property Developer Network. You have not disappointed, mate. This is definitely something that is going to be contrary to most of our others on the panel. And for anyone that wants to really, I suppose, fuel growth and put that extra effort in, this is something worth watching again. I thank you so much for jumping on the panel, mate. And thank you for spending time on the show.
Mate, my pleasure. Anytime. Thank you.
All right, I feel like I'm saying this every single episode, and I know I just made a point of it, but seriously, go back to step number 6. I'm pretty sure it's 6 that Rob said, talking about all of the different ways that you can get started. And the reason I'm making such a point of this is because even if you're on 30K and you're like, oh, I can't start just yet, I'm working part-time, I'm at Macca's, whatever it is. And if that's your situation, rewind a few episodes to Max Jennings. He'll show you exactly how you can start. But if you can look at these different options, you can see how some of them a little bit higher skilled, some of them a little bit lower skilled. Some of them do take a little bit of money. Some of them take absolutely no money. And it's one of the best ways to just get experience, because even if you don't go down the action path and actually put it all into action just yet, you're going to soak up so much knowledge in the property industry that whether you become a developer or not is absolutely going to be valuable as you build a portfolio over the years. But as far as getting started today on 90K, Rob Flux has outlined some very different but very useful steps to do exactly that in 2024. But now it's time to get the opinion of a mortgage broker with over $20 million portfolio who's both invested and developed his way to an absolutely successful lifestyle, and find out the 7 steps Richard Morgan would take to start again today if he was on 90K. Richard Morgan, how you going, mate?
Really good, Todd. Good to see you again.
Mate, it's good to see you. I love chatting finance with you, love chatting property investing. You're now the 4th and final investor on our panel. So we've had a few different opinions so far, but I'm assuming, and I could be wrong, but you're going to be unpacking this from maybe a little bit more of a financial perspective. But before we jump into the steps, is there anything that you wanted to set the stage with, Richard?
Yeah, look, Todd, I think this is a really good challenge. Certainly something that we see investors facing every day. And I think when you put yourself in a position here, like we've done today, it's really sort of exciting to unpack it and put together some steps to go, okay, if I was going to do this again, what would I do today in that position?
It makes you think, doesn't it? Because you can't quite do it exactly the same way. There's variables that do change. Hence why I think this is going to help a lot of people.
The market is a lot different, today to what it was when I went through that process and started those steps initially. So, with that in mind, things have to be done differently. But I think I've got a bit of a plan we can make work.
Love it. Let's kick it off with step number 1. Richard, what have you got?
All right. So I think this is, the theoretical step. So really the first step is self-education. You need to really surround yourself and immerse yourself in the world of property when you're first starting out. So that means books, from theoretical stuff like Rich Dad Poor Dad through to more specific literature around property investment and different strategies to create wealth through property. If you can network with other investors, if you can set up, a team to support you through that journey over time. So, making sure you're partnering with a good accountant, make sure you've got a good broker, make sure you're starting to network with the people that you'll be involved in along your journey with property. And particularly if you're thinking along the lines of what I am, which is more value-added strategy when it comes to property, you want to start to sharpen that skill set in terms of understanding and networking. And that might mean building a network of the people that you'll need along the way, trades, draftspeople, and so on and so forth.
Okay, so step number 1 then, if it's self-education, I'm putting you on the spot now. If you could only recommend one book, I know you want to recommend like 10, 20, there's a million good ones out there, but what's the one that comes to mind as like, this is the one to start with?
You know what it is for me? All this stuff at the end of the day comes down to mindset. And so I think the book that unlocked that for me more than anything else was Rich Dad Poor Dad, just around that mindset of investing and understanding and applying a lens to look at the world differently. Because I think, there are some tangible things when it comes to property investing and investing in general around, capital is a limited resource. Certainly in today's finance environment, borrowing capacity is a limited resource. So you need to allocate them out as efficiently as you can. But if you can nail the right mindset, you can find what that next roadblock is and find a way around it. And I think that's more valuable than, looking at finite resources.
Love it, mate. What's step number 2?
Okay, so now you know a little bit about property. Step 2 is just get straight into it. So I'd be making my first property purchase as an investment. I'd be using a parental guarantor, so I can purchase the entire value of that property without putting a cent down, and effectively make that as tax effective as possible for future. So it'd probably be something around a $500K price point. Something potentially needs to be more regional at that sort of price point, not in Metro Sydney. But it would be looking for something which is, as good a quality property as I can, as close as I can to, metro areas, and something I can add value to with very basic cosmetic renovation.
And for anyone listening going, all right, I don't have the parental guarantor as an option. If they've got around 80 grand saved, like our fictitious character here does, are they still able to, like from the lending side of things, are they still able to get something around that 500K mark just on like a higher LVR?
Yeah, there's always opportunities to look at LMI with investment. I mean, some banks are going up to 95% these days, which is a change from where they were previously. So there's a bit of appetite there. And, ultimately, depending on what tools you've got to work with, you would choose the most efficient finance structure or finance option you could. So if you didn't have a parental guarantor, then, potentially you would look at weigh up those different scenarios and the trade-off around, being more expensive with LMI and getting into the market that way, looking at what value you can add, what sort of capital appreciation you can get versus waiting a little bit longer, having a little bit more of a deposit and going at, say, 88% plus capped LMI to keep it under 90% and save a bit of money that way.
Mate, you've taken me by surprise because I feel like you've jumped from like step 1 to 7. It's like, all right, education, bam, now do it. And it's like, I'm really eager now to hear what the rest of the steps are, because this feels like you're about to take much more of a scaling approach rather than a like micro deep down in the detail. So what is step number 3?
Yeah, look, I think, Todd, the main thing here, I guess, is I want to go big with where I'm heading on this 7th step. And the other thing is with jumping straight into it, I think action is such a critical thing that you need to take when you have that ambition. And a lot of people get stuck with that. So I've jumped straight into it in this example, so we can move faster. Maybe you'll make a few mistakes along the way that way, but that's also how you learn. So the 3rd step, income is crucial when it comes to servicing and being able to extend that portfolio if you've got an ambition. So I'm looking to start a side hustle. I don't know what that side hustle is. Most probably something that would be an online business, potentially an Amazon type business where you can outsource as much of that as possible, and you can scale that up without investing too much money. Something that's relatively passive and something that doesn't leave you in the trap of swapping your time for money like you would do if you were an Uber driver or labouring and all that sort of stuff. So I'd be starting that side hustle. That will take some time to build momentum to the point where it'd be profitable enough to be able to add to your taxable income. But effectively, once you've got 2 years of tax returns or an 18-month-old ABM, if you're trading profitably, you can add that taxable income into your loan applications and then boost your servicing that way. So that would be a critical part of sort of building that income stream to try and assist with that.
All right, so a side hustle, increasing the income. Obviously, the more you earn, the more you're going to be able to borrow. But you're not talking about like doubling your income. You're talking about maybe earning like an extra 10, 20, 50K, whatever it is on the side. Well, if someone does earn like an extra $20,000 a year, what is that translating to borrowing-wise?
Yeah, it's really, really rough. You could sort of look at about 4 to 5 times what you're earning, translating to borrowing capacity. So you're earning another 20K a year. That might be around another sort of 80 grand per year in borrowing capacity.
So like $400 a week might kind of feel like not much of a dent's really being made, but that could genuinely be the difference between getting another one or having to sit on the sidelines for years.
Correct, exactly. I think it's with this stuff, the more sort of small things you can do, they really ladder up and they scale up, and they can have a much more profound effect on your overall position over the long term.
Love it. Okay, what are we looking at for step number 4?
Okay, so step number 4, because I haven't really used much of that deposit from that first purchase, I would then contribute that towards a second investment purchase. So again, probably looking for something similar to what we did with purchase number 1, buy something around that $500,000 mark, hopefully accumulate a little bit more deposit from where we started initially, and then, put that towards this new purchase, most likely with a little bit of mortgage insurance. And again, something that you can add value to, a bit of a cosmetic renovation, get an uplift on the rental yield, and hopefully a little bit of a boost of capital value.
So when you say you haven't used much from the first deposit, so this is why you were going down more like the parental guarantor route, something along those lines, because you wanted to hold on to as much capital as possible to spread it across multiple properties.
Correct, exactly.
Gotcha. Okay. All right. That makes a lot more sense now. So you're going to the second one. I can see where this is going now. You are going like bullet out of a gate. And how are we looking at step number 5?
Okay, so again, the income piece is where we have hit a hurdle here. So we bought 2 properties. That's going to completely tap you out in terms of borrowing capacity. That side hustle income is probably not online yet. The other iron that you need to put under the fire, if you've got that ambition to build a big portfolio, is around what your career looks like and what that base income looks like. And I think, you need to tap into that rich dad, poor dad type mindset to look at the world differently and think about, okay, well, there are no restrictions around what you can do other than the restrictions that you put on yourself. That 90K a year, whilst it's a reasonable amount of income and a lot of people would be happy with that, if you have an ambition to scale up and build a big portfolio, that's not going to be enough. You're going to want to double or even triple that income, which means you need to find something that you can do which can provide you the ability and the earning potential to get to that sort of level of income.
Talk to me about mindset around that, because I feel like you're talking about rich dad, poor dad. The first one's self-education. Now we're talking about upgrading your career, but talking about doubling, if not tripling your income. I can't help but think, and I really hope I'm wrong if you're listening to this right now, but we've lost a significant portion of the audience that have just gone, wait a second, mate, I'm not earning 380 grand a year or whatever. Yeah, I don't know if my maths is right. They're 370. Talk to me about unlocking that
270,
mindset.
yeah.
270, there we go. Yeah, I was way off. Talk to me about that mindset to be able to go, no, okay, let's look at this a different way. How can I?
Yeah. So I suppose, if you draw it back and go, okay, well, everyone gets a certain amount of time that they can use in a day. If you can think about, how to maximize the value that you can generate in that period of time, and go, okay, well, what are the different career paths that I have available to me? Mm-hmm. What are the gaps in my CV that I can address? Do I need to go and get trained up? Do I need to go and get a degree? Because when you're talking about building a portfolio and serviceability, that's really the number one thing that is going to fuel that portfolio, and that will define how far you can go with property investment. Thinking about, okay, well, what is the activity or what is the job role that I could do that has a high ceiling in terms of earning potential, and
Mm-hmm.
There are a lot of different roles out there that can facilitate that. I mean, the most probably relevant one is if you can go out and be a successful real estate agent. You've got the ability to earn uncapped commission there. If you're into real estate, then that's something that you would have a love for and a passion for. And I think that's also that's great if you can align earning potential and passion for what you do every day. But often it's not the case, and you might find that you have to make some choices around working harder in roles that you don't enjoy to try and earn as much money as you can to build that portfolio. But the view is that you're not going to be doing that forever. This is going to be a means to an end. And so pushing yourself career-wise to try and maximize your income. Obviously, more income, more servicing, it's pretty obvious. There's no easy way to go from a low income to a high income. You've got to find a path through that's relevant for you. And you've got to find what matches up in terms of your skill set and your ambition to try and maximize that income.
So what I'm really hearing there is, if someone's seeing this and looking at it through a real lens of like self-doubt of I can't do that, don't try and fix the yes, you can do it. It's not a motivational thing. You're taking a pragmatic approach of start listing out all of the potentials. They don't have to be the guaranteed slam dunks, but the potentials that could help lead you down that path of earning more money. And I guess that would really start squashing that feeling of I can't, because now all of a sudden you're surrounded by all these different reasons of what you potentially could do.
Yeah, exactly. I think it's just putting a different lens on it and going, okay, well, what is possible if I open myself up to the possibility here? What could that look like? And, can I go after that opportunity and try and make it happen? Because really, like I say, the only limit that is on you in terms of being able to achieve these things is the limits that you put on yourself.
It's so true. And I'd actually be interested to hear if you still go through those growth limits where you keep putting them on yourself. Like, I remember the first time I earned 100 grand a year and it was like, I just thought I'd be the richest man in Babylon doing that. And now it doesn't feel like anything. And then you just keep going through these different steps. But I'd imagine that the limit is just continuously evolving.
Yeah, and there's different pressure points, right? You'll go through that self-doubt for sure, because a lot of the time you meet resistance. You might be in a corporate role looking for that next role, that next promotion. You might get knocked back, and that might happen 2-3 times. That might mean, okay, well, I've got an obstacle here. I can't get promoted internally. I need to go and develop my network with recruiters and find some good recruiters I can align myself with so I can find some external opportunities that are going to be better for me. So there's a lot of different stuff you can unpack there around, finding a way to navigate those challenges. But those challenges are always going to be there at every stage. And I suppose the easy option is to say that it's too hard and just sort of put up the status quo. But, if you really want to push yourself and you've got that ambition, then, I think you can be rewarded for that hard work and that persistence when it comes to pushing yourself forward.
Absolutely. All right, and step number 6, what are we looking at?
Okay, so step number 6 is most probably a little bit of a crossroads there. So it depends on how those conversations have gone in terms of career advancement, depends how the side hustle is going, depends how the performance of those properties that we've purchased so far are going. But the intent would be to get into the next property. So whenever the time permits to get into that next property, potentially you might need to use a non-bank to get in there. So, the boost of serviceability, it's available by using a non-bank. The intent of this property would be to push the envelope a little bit further in terms of what you can do with renovation. And the objective would be to try and find something that you could buy, add value to, and potentially do a flip. So taking the sort of cosmetic stuff to the next level and hopefully making a little bit of a flip and making a little bit of money on it.
Okay, so we're flipping for step number 6. So just to do a quick recap. Step number 1, self-education. Rich Dad Poor Dad is the book of choice for yourself if you had to pick one. Making sure that you're getting into property number 1 straight away, trying to keep as much money in your pocket as you can. If you can have a really high LVR, even if you've got to pay some LMI, go to the bank of mum and dad if that's an option. You want to go into that. Next, you're looking at increasing your income through a side hustle. Then you're looking at going into your second investment property because hopefully you've saved a little bit more money, you've still got a bit of money set aside, and you can smash into property purchase number 2. Then you're looking at upgrading your actual overall income, whether that's upgrading your education, completely changing your career, whatever it takes to try and earn as much money as possible. Now we're trying to get into property number 3, but as a flip to keep building the capital base, if I've understood you right there. What are we looking at for the final step, Richard?
Yeah, so the final step, I suppose, is trying to take the active strategy to the next level. So we've moved around the edges on cosmetic renovations, on passive properties that we're holding. We've got a little bit of an asset base there. We've hopefully done a successful flip where we've done a little bit more than a cosmetic renovation and built an improvement and an uplift and been able to capitalize on that. For this one, potentially we're buying something a bit bigger. Potentially we're doing, a DA. Might be a DA and a flip. It might be a DA and a small extension and then a flip. But we're starting to go down the property development path at a very sort of low level. And that is obviously capital intensive. It is borrowing capacity intensive. So everything would need to line up to be able to start doing that. And certainly the first one will be a risk too, because there's not going to be an awful lot of buffer in terms of spare capital and borrowing capacity. It'll be something that would most probably be an all-in proposition. So that would be what I do as the next step. And then hopefully rinse and repeat and keep building that capital base. And then eventually, once income continues to build, you can continue to build the passive portfolio alongside the active strategy at the same time.
I like this. So you're into the portfolio straight away, doing everything you can to increase your income, but then also everything you can to increase your capital base, but using property as a vehicle to do that. So then you can continuously strengthen your position to grow and grow as time goes on. Is there anything that I've kind of left out of that wrap up?
No, I think that's pretty much it. I mean, the intent of this plan is to go as fast as possible and sort of build a few little streams there that are going to help you with that long-term piece. hopefully by the end of it, you've got good sort of passive base to continue to build to, and also an active strategy that you can leverage over time, and hopefully that'll put you in a good position in terms of sustainably building wealth through property.
Awesome. Richard, you have not disappointed. Really appreciate you jumping on the show and taking the time out. Richard Morgan from Freedom Funding, thank you so much for jumping on.
Thanks for having me, Todd. Appreciate it.
You know, the biggest reason I wanted to make this episode was because there is such a strong media narrative now on how it's impossible to not only just buy a property, but become a property investor. You're an evil, greedy landlord if you're a property investor. The fact of the matter is we need more rental stock. We're in a housing crisis at the moment, and producing more rental stock is one of the ways out of that. So if you can help the problem, but also solve a future problem of retirement for yourself as well along the way, that's a win-win that I personally want to be a part of. And I hope you do too. The fact that you're at the end of this episode listening right now, I'd go out on a limb and say that you do want to be a part of it, which is why I wanted to have 4 incredibly successful investors outline the ways that they would start. Because you know what? The one thing that I've learned after doing 500 odd episodes myself and building my own portfolio to 10 rental properties is that there is not one way that works. There is a lot of different ways that you can do this, that you can build some serious wealth, but it's got to be the right way for you. So whether you're doing that the Mat Fisk way, the young entrepreneur that's absolutely setting the world on fire, going out more regionally, buying lower value, higher yielding assets, that's cool. Maybe those are the steps you need to start taking. Or maybe you want to stick a little bit more to the route that Cate Bakos has outlined by maybe having like a bit of a PPR. Maybe you're wanting to live like closer to the city still, get a unit that you can put a little bit of value behind, or potentially rent vest, get something that's regional Victorian. Cate has built an incredible portfolio herself and has been a buyer's agent for a long time. She knows what she's talking about, and it's stuff that has worked tremendously well for her and her clients. Maybe that's what spoke to you. Or maybe you want to get super active and go, I'm not waiting for the market. I'm going to take the Rob Flux approach. I'm going to start learning as much as I can. I'm going to delve into a community and I'm going to start adding value, forcing value, creating value, however you want to put it. But the amount of different ways that you can do it in property development is kind of mind blowing. So if you're going to go down that rabbit hole, set aside a little bit of time because you're probably going to need it. But if you do it well, oh my God, like the BRW Rich list is filled with property developers. Let me just leave that thought with you, okay? If you're wanting to go down the serious wealth building route. Or maybe you really clicked with our final panelist, Richard Morgan, and you want to be just that bull out of the gate. You want to go like, I'm going to leverage myself. I'm going to go hard. I'm going to increase my income. I'm going to do whatever it takes to build that capital base as high as I can. Also increase that cash flow as much as I can, both through adding value to property, to increasing my income, to maybe starting a side hustle. Because you're understanding that the things that you need to do to borrow and really tick the boxes in the bank size are exactly that. Show them that you've got good capital base and really strong cash flow. And again, Richard has built a very successful portfolio. When he talks, I listen. Well, actually, when all of the guests on our panel today talk, I listen. And I hope you do too, because this is information that could genuinely be the difference between the start of a life-changing 2024 and all of the rest of the people that unfortunately just want to believe the media narrative that it's impossible and you can't do it. And it's just not true, because you can.